Or you can save up your cash over time to buy it later. Let's look at what that actually means for your wealth. This line represents a neutral point where you have no debt, but you also have no savings. We'll call it the zero line. Under those two traditional methods, borrowing or saving, your money is permanently tied to this baseline. No matter which path you choose, your financial growth is limited by this constant pullback to zero. Let's see what happens when we choose the first option. We'll call this person the debtor. The debtor wants that computer right now, so they take out a loan or swipe a credit card to get it. As you can see, the moment they make that purchase, their financial value drops sharply below the zero line. They are officially in the negative. Now begins the long grind. Month after month, they make payments. It's a slow, grueling climb just to try and get back to where they started. And here is the penalty for choosing this path. A large chunk of every single payment goes toward interest, which is just an extra fee for using the bank's money. This means the debtor pays much more than the computer's original price tag. Eventually, they make that final payment, and the line reaches the baseline again. But they are back at exactly zero. They have the computer, but they have no money, so they'll likely have to borrow again for the next big purchase. The debtor spends years working just to pay the bank. They sacrifice their future income to claw back to a net worth of absolutely nothing. You might be thinking the second option is obviously better. Let's look at the saver. This is the person who believes that cash is king and avoids borrowing from anyone. Starting on the zero line, they put money into a savings account every month. We see these steps building their balance upward. The bank even gives them a tiny bonus for letting their money sit there. Then comes the big day. They have enough cash to buy the computer outright. In a single moment, they trade all those years of accumulated wealth for the item, and their balance instantly crashes back down to zero. By draining their savings, the saver triggers a hidden cost. They no longer have cash to use as security if they want to buy something else, and they have completely interrupted the momentum of their money growing on top of itself. To buy anything else, they have to start that building process all over again. The cycle of growth has been reset to the beginning, and they face another slow climb up from nothing. On the surface, the debtor and the saver might seem like complete opposites, but let's look at these two paths side by side. When we fold them over the center line, you can see that they are perfectly symmetrical. They are exact mathematical and behavioral mirror images of one another. Whether you pay a fee to a bank or sacrifice the extra money your own savings could have earned you, the result is the same. Both traditional methods leave you stranded at zero. If the debtor and the saver both end up with nothing, is there a way to make a purchase without ending up back at zero? There is a third way. It's an approach where you essentially act as your own financial institution, allowing you to finance your purchases entirely through yourself. Instead of taking your money out of your account to buy that computer, you keep your savings exactly where they are. You use that account as security to borrow a separate set of funds for the purchase. Because your original money never actually leaves, it never stops growing. Since your original savings stay put, they continue to earn money on top of money, day after day. You are using a different pool of funds to buy what you need, while your own wealth keeps its momentum. Look at how this changes the diagram. When you make a purchase, your wealth line doesn't crash back to the baseline. It keeps its height and continues to climb. You've broken the cycle of returning to zero. This strategy means you can create a continuous flow of cash off of any purchase you make. Your money is always working for you, even while you're using it. You don't have to spend your life on a staircase that leads back to nothing. By stepping off that traditional path, you no longer have to choose between debt or draining your savings. You finally have total control over a financial future that never has to reset.
Anybody have any comments on that? All right. I'm going to show you something here then. Give me just 1 second to set this up. So one of the things that Christy and I were talking about, and this is a little kind of a prelude before you get talking about what we were advertising. So we'll talk about that in just a second. But one of the things that seems like people have a difficult time is this concept of what it costs you to pay cash. And so I thought I would show you something that I think you'll find interesting here. So give me just a second to set this up. Okay. So this is based on the.
Oh, yeah, okay, Lynn is fine too. We get it both.
Okay, if you guys can mute yourself, that would be really appreciated. Okay, so here we go. So here's the question: how do you want to pay for something? And I'm gonna set this to over a 30-year period of time just to kind of exaggerate or help you see what's really going on. But so let's assume that you're going to use compound interest, and let's say you've got $30,000 in an account that's earning 5%, and the amount it's earning is really not that significant actually. But here you've got $30,000 and you decide you want to pay cash for something. So that $30,000, had you not interrupted, it would have grown to 134,000. And this is, so if you think about this, how do you avoid this loss? Because that's pretty huge. That's this is over 30 years, but that the interest that it would have earned would have been 104, plus you add the 30 back in, and you'd have $134,000. So think about that. That's what it costs you to pay cash if you took this $30,000 and gave it up, if it had been earning 5% for all that time. So people want to pay cash. Well, the other side of things is we do what's called amortized interest. So in other words, you go borrow $30,000, and let's assume that that the interest that they're charging you is the same that you would have been earning over here, just for discussion purposes. So this $30,000 at 5%, the interest that you'll pay over that period of time is $27,977. However, you've lost the principal and you've lost the interest. Think about that. You've lost the principal plus you've lost the interest. So if we look at this and we say, what if the interest was earning that 5%? Instead of giving that interest away, that 5% that interest would be growing at 5%. That interest would have grown to $76,000. So here we have the accumulated interest, okay, plus you've got the annual cash flows. So both of those together, okay? But it even gets worse than that because you also lost the principal at interest. Had the principal at interest been earning, that would have earned $57,000. So
in other words, the interest on that interest,
Yes,
like on that compounding effect.
This is actually on the principal. This is on the interest on the principal. But then if we look at the total purchase cost, look at this. This total purchase cost right here turns out to be $134,000, which just so happens to be the same that's up here. Now, what do we draw from that? Whether you pay cash or whether you pay cash or you finance it, it's the same. Let that sink in for a minute. It's the same. So
that's a great example, Jim, of that old lesson we had where you're relinquishing control of your money. Once you spend that, the one way, it's just utterly gone. Otherwise, you retain control over that and it continues to work for you.
Yeah, so the idea is bring it back to you.
Yeah.
Now, please understand, we're not talking about financing your candy bars and your lunch that you have today. We're talking about major purchases. And major purchases depends on your station in life, as they call it. In other words, if you're a brain surgeon and you make $5 million a year, what's important to you is not the same thing as somebody who's making $50,000 a year. But whatever you consider to be a major expense. This video that I just showed you is talking about buying a computer. Well, I know people who anything over $1,000 they'll run through their banking system. Other people, $100,000 they're carrying that around in their pocket. So it depends on where you are. But if you think about what we're really talking about here is recapturing what would have been lost had you gone through either paying cash or borrowing the money from somebody else. But then I want to ask the question, what if you were the banker? Wouldn't this 134,000 end up coming back into your pocket? The answer is yes. Now, many of you will look at your cash value, and Christy's going to talk about this a little bit. Many of you look at your cash value and you'll think, man, that's money that's sitting there not doing anything. I need to use it. I need to put it to work. And several of you have heard me use this phrase when it says, money makes money when it moves. But what I want you to understand is that's true. But the life insurance policy, the life insurance company is moving your money for you on your behalf. And it is growing. Okay? You don't have to put that money at risk. And that's one of the messages we want to get across, at least I want to get across today, is you don't have to put your money at risk. We talked to a business person this week. Actually, he was a real estate investor, and he had a loan for, I think, $75,000 on his policy, and he thought that was going to the insurance company, and he would never see that money again. And I said, wait a minute, who owns the insurance company? The answer is we do. That's not insignificant. We own the insurance company, which means when the insurance company gets paid, and when you pay back a loan to the insurance company, yes, it goes to the insurance company, but they turn around and put it back into your policy, into your cash value, and as if it never left, because it didn't ever leave. So, Christy, you want to take it from here?
Well, leave that up for a second. So really quickly on this, because I think that this is probably the biggest concept that people misunderstand, which is to understand that when you're putting money into a policy, you're basically kind of building your own banking system to be able to utilize. So if you're putting into your policy $10,000 per year, you're going to be able to borrow a portion of that $10,000 that you just put in. Every year that you're putting into your policy, that is going to be compounding, and you're going to have a higher and higher percentage of what's available for you to have access to. Okay. Now, if you look at this top one that my dad has up here, where it's saying, okay, if you have the ability to have this growth be happening, well, what if you can have this growth, but then as it's growing, let's say that this represents, I don't know, let's say this is $5,000. Okay. Now, let's say that you have a credit card for $2,000 and you want to take that and use that to pay off that credit card debt, to basically refinance it at a lower interest rate. That's what you're doing, is you're building up a credit line that allows you to be able to finance more and more of the things yourself, so that if you have debts that are coming up or expenses that are coming up, you have the availability to use it. Now, when you're doing a policy that we put together, you're able to still have this growth curve be happening, even though your ability and your credit line that you have available is also growing. And so you can use this for your everyday expenses. So then this loss right here, where you have to choose, do I want it to grow or do I want to go into debt to pay for that? What we're saying is with a policy, you can do both. You can have it grow and then also be giving yourself a credit line to use that, and then put that back and still have it keep going up like this. So you understand the difference there? So we're saying a lot of times people try to figure out how to separate their dollars. And so they're saying, okay, well, I can either pay off my house or I can save up for retirement. And they feel like they have to choose. Or they say, I can either pay off my debts or I can save for retirement. Okay, we're saying don't choose. When you have it go into the policy, then it allows you then that cash value that you have available to you to then use to then help you pay off your debts, so that it's still doing the same thing that you are already doing. You're just adding an amplifier to it. And you're adding an enhancer to where you're allowing your money to still be compounding and growing, even though you're using it to pay off things. Now, I want to be very clear here and say that I don't also want anybody using their policies and saying, oh, that gives me permission to over leverage. No, it does not. It gives you the permission to become your own bank. So if you wouldn't budget, like if you said, hey, okay, I need a new car, and you said, I need a new car, I have two options. I can either pay cash or I can pay an interest rate and borrow the money. Okay, we're saying you now have a third option, which is to say, okay, you can also use your own policy cash value and then borrow against your own account and then replenish it the same way you would if you were using an outside lender. Okay, that's being an honest banker when we say that. That doesn't mean rob from that account and just take it and then magically it's going to just fill itself back up again. That's not how these policies work. It becomes a source of funds for you to utilize so that as you're putting it back, then you're using it again for tax-free retirement income later. And so if you take money out of that account, out of the policy, and then you use it for something and you don't replenish it, you just stole from your account. You didn't replenish it. Okay. You wouldn't rob a bank. Don't rob your own bank. So that's what that means. But it allows you the ability to have that still be compounding, even though your ability and your equity that you have access to is growing along the way. And so that's something that for me, I had a really hard time wrapping my brain around it. And I know that we have a lot of you guys that have those same kind of questions. So hopefully this is helpful to understand. So when we're talking about different ways to use your money, because that's another question that we get all the time, which is basically what the topic is. People will say, okay, well, if I'm putting my money into the policy and then I have access to it, what should I be using my policy for? Okay, so first and foremost, the policy is going to grow well, even if you don't use it for anything. Okay, so what about your 401k? Do you ask your 401k and say, hey, you know what? It's growing and it's doing something, but what else can I use it for? No, it's already growing. Okay, your policy is the same way. It's just that with your policy, you have access to it to be able to utilize it for things along the way where you're limited on a 401k to do so. If you want to borrow from your 401k, what are your limitations?
First of all, you are borrowing from it, not against it, which is also huge. When you have a 401k, you borrow you borrow from it, which means the growth curve that you just had drops. And when you pay it back, you start from where it was. That growth curve does not continue. That's when we talk about borrowing from. You borrow from a 401k, you borrow from the bank downtown, you borrow against your house on a HELOC or a mortgage, and you borrow against your life insurance policy. It's the same thing. The main difference is you've got guarantees on a policy. You don't have guarantees in your 401k. There's no guarantees in your 401k, and there's no guarantee on your house. And what I mean by that is your house could go up in value, or it could go down. We were talking to several people this week about that they're realizing that housing prices are coming down. So if you think you've got a certain amount of money in your HELOC, all of a sudden you find out that, I mean, yes, you do have that in the HELOC, but the value of the house could easily drop 20, 30, 40, or 50%, as it's done several times in my lifetime. So you're borrowing against that, but you don't have the guarantee that you have on a life insurance policy. The life insurance policy has guarantees. It has a guaranteed death benefit, which you're going to use and spend in retirement. And it's got guaranteed growth that you're going to use and possibly replenish in the policy on the cash value. Okay.
So in this example, if this was in a 401k, so on a policy, if you're borrowing this part right here, you're still having it grow like this, right? It's still being compounded and growing because you're still earning dividend even though you have a loan against it. Okay. Now with the 401k, if you borrowed from it, then the account value goes like this because that would be like where your loan. Does that make sense? So that's why that interrupts it.
That's the back to zero mechanism.
Mm-hmm. Yep. So I talked to a guy, actually the reason why I was late getting on here is I was talking to a client who he got a policy with us about 5 years ago. And he wanted to do a strategy session because he said, man, I'm in a tight spot financially and I need some advice. So I was going through and updating his financials with him, and he's got a ton of debt. He just has a lot of things that just kind of snowballed on him, and so he's just trying to kind of dig his way out of this debt. And I said, you know that your policy actually has the ability to help you with all this, right? And he said, yeah, but remind me how to do that. So that was our conversation. So here he is paying, I mean, a lot of these debts are, his lowest debt is like 7.5%. His highest is at, I think, 28%. And it's about 50,000 that he has in debt. And so he said, well, I haven't really funded my policy well. I've kind of minimally funded it. And he was wanting to know if he should maybe even cancel his policy. And I said, that policy is your best tool with all of this stuff. So if you put paid up addition into it, and then you turn around and you take that back out and use that to pay off your debt, you're going to still have that policy be growing. And then you're able to refinance your debt at 5.3%. and then have that policy continue to grow. And he was blown away at that because it's like these are debts that he already has. He didn't look at that as an opportunity to use the policy to help him to save thousands and thousands of dollars. His plan was just to try to like throw everything toward it that he could. And so he's paying an extra $1,000 a month toward all these different debts, trying to get them tackled. And I said, if we put it in the policy first and then throw it on there, then you just refinance that debt at 5.3% and then have that policy that's still growing versus what he's doing right now, which is taking out a 401k loan. And his comment to me was that, well, on that 401k loan that I'm taking, I'm getting myself that rate of return when I put it back. And I said, well, while it's out, are you earning on it? And he said, well, no. And I said, so are you really getting earnings on it, or are you just putting it back? And he said, oh, yeah, I guess I'm just putting it back. So you need to understand the difference there is that you're really just kind of putting it back into the rotation of it. You're not earning while it's out. And so that's the difference between the vehicles that you have between a 401k, which is not necessarily a bad tool. It's just you have to understand what's happening with it. So no different with a house. When you have a HELOC or a mortgage against a house, does that change the value of the house? No. The value of that house is going to continue going up with inflation or down with inflation, however it's going to be going. So sometimes we feel this need to have money be moving, and we feel like that because money needs to be moving, we need to do all of these high risk investments and everything else. Sometimes our best investment is to just refinance the debt that we're already paying on. It's just that we're paying it to somebody else instead of replenishing our own system with it. And so that's what we're talking about here is that when you're in a tight spot, especially, that's where these policies come into play the best, because you can say, okay, well, I can either pay toward the debt or I can pay toward my paid up addition and then pay toward the debt. By doing it that way, you're allowing yourself to be able to capitalize on that debt that you just paid down. You understand that? So
One other quick comment on borrowing from your 401k. When you put money into a 401k, you get a tax deduction, or what we would really call a tax postponement, because you're going to pay the tax later at an unknown time and an unknown rate. Let me talk about that very quickly. You have, and when you are taking money out of your 401k, you have no idea what the interest rate's going to be, or the tax rate is going to be when you take it out. I talked to a woman today that she's got over $1 million in a 401k, and she needs the money. She's 63 years old and needs the money, but she's scared to death to take it out of her 401k because it's the only thing that is earning that's earning in a tax advantaged environment. But when you borrow from your 401k, you're paying it back with tax dollars. So you're going to have to earn the money, pay the taxes, and then put it back into an environment that's going to tax you again when you take it out in retirement. Do you realize that? You're paying double taxes when you take a loan from your 401k. You're taking it out. You don't pay taxes on that, but when you put it back, you're having to put it back with taxed money again. So you're having to re-tax the money, and then when you take it out in retirement, you're going to be taxed again. So it's the 401k was never designed for people to use it, to be able to borrow against it. I'm sorry, borrow from it. It wasn't designed for that, but people have used it for that.
You know, another thing, Jim, is I'm looking at required minimum distributions next year, and I'll tell you that is a minimum distribution by their rules. And I don't have as much as many probably at this point because most of mine's back in my policy. But anybody who has a high balance in their 401k is going to have a minimum distribution payout, which is going to be most likely for them a larger tax chunk than if they began, moving this over into a better environment like a policy.
So let's talk about minimum, since you bring it up, minimum required distributions. Think about this. How do they determine what the minimum is? It's based on your life expectancies. Yeah. Your life expectancy. Who figures that out? The federal government. Now that they're looking at life expectancies for the whole population.
You can see every single individual hair on this guy's face.
Okay. And so they're figuring it on life expectancy according to the federal government, which they're looking at everybody's life expectancy. Life insurance policies also have a life expectancy that you can figure out what your life expectancy is, because they know exactly what the lifespan is of the people they insure. They don't insure everybody. The federal government is looking at life expectancy for everybody. But here's the bottom line. What is your life expectancy? You have a better idea what that's going to be than even the insurance companies, because you can look at what's happening in your family. You know, how long do people live in your family? Do they live into their 80s or they go into their 90s and hundreds? Then you can calculate sort of your life expectancy and make your policy last as long as your life expectancy according to you. So you don't have minimum required distributions. That's one of the powerful things about this. There's no restrictions on when you can take the money out. Either you take it out as a loan or you withdraw it. And there's no idea as to that you have to take it out by a certain age. No minimum requires distributions. And when you get to be David's age and older, that's a big deal, because you may not want that money coming out of a tax related or tax advantage account. But the IRS says, oh yes, you will. And if you don't take that, David, do you know what your penalty is if not taking it out?
I haven't looked at the exact penalty yet, but it's a bite.
It's a bite. It used to be 50%.
Oh, no.
They lowered it this year to 25%. Isn't that wonderful? That's the penalty, not the taxes. You'll still have to pay the
Right.
taxes and the penalty. So you might miss it once, but you won't miss it after that.
No.
I got a question.
Yes, go ahead.
So when you're talking about taking out a loan against your policy, whether I know you mentioned major purchases, but in the situation you guys were talking about a credit card, do you always charge yourself more no matter I'm sorry, from an interest rate standpoint, more than what the policy is charging? Do you always charge more no matter what type of loan it is, or are the credit cards right at what the policy charges versus major?
Well, so here's my answer to that. If you borrow money for business or investment purposes, and you set it up right, when you do that, and we will help you with that. And this gentleman that I talked to this week that has the real estate, he didn't realize that he could get a tax deduction for the interest that he's paying because he's a real estate investor.
Mhm.
And I helped him understand that next time he takes a loan, and by the way, he's paying that back, just putting it back in the policy, and then he may turn right around and borrow it back out again. But this time he'll do it right, and he'll set it up as a loan to his business, and his business is real estate. And so he can get a tax deduction. So Curtis, think about this for a second. The insurance company is going to charge you right now 5.3%. Let's just call it 5 to make it easy. You borrow the money from the insurance company, and again, you're borrowing from the insurance company. You're using your policy as collateral to borrow their money.
Correct.
Now you've got the money at 5.3. So that's your cost of money. Let's call it 5%. So your cost of money is 5%. You turn around and lend it to your business. If it's a real business, especially if it's an LLC or an LLC that's taxed as an S corp. Okay. In other words, you're really in business. You lend it to your business, and what rate do you want to charge your business? Because you're the banker. Your business is not you. The business is your business is a separate entity from you. How much do you want to charge them? And this comes back to your question. If you're borrowing money right now, Curtis, from the marketplace, what are they charging you? What's the interest rate that you have right now? Or what is an interest rate? Let's say that you're getting an unsecured loan. In other words, you don't have any collateral. If you go to the bank and say, I need to borrow I want to borrow $50,000 on my good credit. Most likely they won't even do that.
Right.
But if you went to your credit card and put it on a credit card, what would the credit card company charge you?
Oh, probably about 29, 30%.
Okay, 29 or 30%. Exactly. So here's the question, Curtis. How fast do you want your policy to grow? How much money do you want to have in a tax-free environment when you retire?
As much as possible.
And that's the answer, as much as possible. So if you're paying 29% on a credit card right now, that really should be a business expense, my advice to you is refinance it, but not at 5.3. I would refinance it down to about 12 because you can easily afford 12.
Mm-hmm.
Okay. Now that money is going to, from on the business side, you're going to get a tax deduction for that.
Okay.
Okay. So I mean, you get a tax deduction. Now the money can come into your policy, and the bank, I mean, excuse me, the insurance company is only going to charge you 5, but you're earning 12. So there's a difference there of 7. Now we're probably getting a little ahead of ourselves here, but how's that money taxed? It's not ordinary income, it's investment income,
Mm-hmm.
which means you don't have to pay self-employment tax on that.
Mm.
Ah, what's self-employment tax? 15.2%. So simply by running it through your policy, you're going to save 15% on taxes.
15% or more on your car insurance. So
Okay.
part of it too, I'm actually going to hijack the screen for a second because I think
Yeah,
this
go
kind of goes
ahead.
to your question, Curtis. And by the way, we had another good comment. Chuck sent me a private message and said, borrowing against your policy like that, it would be like having a margin loan that you could get against your brokerage account and having it still actually be compounding and growing while you're actually taking a loan. And that's a really good analogy. Like when you think about the power of what you're able to do, to let it still be compounding and growing, even though you're using it for something, allows it to then be you're replenishing it and just giving yourself that line of credit to use it for the next opportunity or expense or whatever it is that comes up. Okay, so this is some software that we use. My dad was just using the same software. We use this a lot for illustrating points and purposes. So Curtis, one of the questions you asked, so let's say you've got a $10,000 loan. Let's say your interest rate right now is at 10%. Doesn't really matter what this could be 8, doesn't really matter. Let's say that right now your scheduled payment on that is $300 a month. Okay, so you've got your balance here, you've got your interest rate, you've got your payment. This is loan principal and interest payment. This is over a year's time. So
Okay.
this is saying, okay, in a year, I would pay $877 in loan interest.
Mm-hmm.
This loan interest payment is with the C is cumulative. And then
Okay.
it's the end of the year balance. Okay. So
Okay.
when you're taking your policy and you're refinancing it, what we're suggesting to do is to say, okay, when you have 10,000 in cash value in your policy, and by the way, if a bank wouldn't lend to you, you wouldn't lend to you either. So you want to kind of make sure that you kind of keep that in mind. But assuming that you want to lend to yourself, then you
Mm-hmm.
say, okay, I've got this $10,000 balance here and I don't want to pay this anymore. And I've got enough cash value that I am fine with this payment. Maybe I keep this payment the same, but now look at what we have as far as cumulative loan interest. So see how we've got 1,764 here. What
Correct.
happens when we change this to 5.3?
Oh.
Okay, now we're down to 841.
Mm-hmm.
So what we just did, now this is assuming we don't get any of this back, which we do, but let's just assume that all of this is just pure cost. We get nothing in a benefit from our policy. This allows us, even that by itself, to go from 1,700 down to 841.
Okay.
Now that gives you more cash flow. So part of the question is, it's like, okay, well, could you give yourself a lower payment because you just lowered your interest rate? Absolutely, you can do that too. But why wouldn't you want to replenish your credit line faster by keeping the same payment that you were already paying out to the outside lender and have that be the same rate or payment that you're paying back your policy?
Okay.
So that's kind of what we're talking about. But the beauty of it is that you have the liberty to decide that. So sometimes if your cash flow is tight and you're
Mm-hmm.
saying, you know what, I've got the amount in my policy, so why not use it? But that 300 really is a little bit tight. I need to drop this down to 250. So guess what? You're still saving more by refinancing it by, an extra $700 cumulatively here.
Okay.
So that's what you have the power to do with the policy is that you're choosing your own payment. So sometimes when we say choose your own interest rate, it really should be a mentality shift to say choose your own payment. And so if I was going to borrow from like right now, we need a truck. We just took it to the shop today, and I'm pretty certain that that thing's going to come back where it's going to be expensive to fix it. So we're going to have to decide, do we want to sell it and get another vehicle? Do we want to fix it? What do we want to do? So if I was getting a vehicle and I knew that it was going to be, let's say, $20,000 to get a new vehicle, and I knew that the bank was going to charge me 6%, and if I wanted to pay it off over a, I don't know, 5-year time frame or 3-year time frame, this is going to tell me if I did it over 5 years. Oh, hang on, not 60%. Huh. Let's say, I don't know, 7.5%. You guys probably know better on interest rates on auto loans. I use my policy for this, so I don't know. But what I do is I look and see, hey, what is the rate? Like if I used my credit union, what would my rate and payment be? And if I was financing that over a 48-month time frame, my payment would be $438. Okay, so I look at this and say, okay, I could do this and use the outside lender, but I'd be losing $3,212. That's none of that is coming back to me. This is all being lost to me.
Okay.
Or I can use my policy, give myself that same payment and drop down the interest and then have that be an availability that I'm using. You see what I mean there?
Yes.
So every time you do these kinds of things, how much are you saving in interest that normally is just lost to you? So not only are you recapturing interest that you normally would be paying out, but you still have your policy values that are still increasing while you're also saving money in interest. And so that compounding effect, so sometimes people will say in a policy, they're like, that's a boring rate of return. It's like, you betcha it is, but that thing is liquid, it's available to me, and I can use it as many times over and over and over again to save thousands of dollars in interest along the way. And what kind of rate of return does that give me? Well, if I was paying out 7.5% and instead I've got this at 5.3, that's an automatic 2.2% that I'm earning on that money just from a transaction I was already doing anyway.
Mm-hmm.
And
Okay.
so that allows me to improve my cash flow because I'm not losing this to somebody else. And it's also refilling up my own line of credit in my policy at the same time. So I usually tell people instead of focusing on what the interest rate is, kind of do the math and see what the payment is, and then give yourself that payment and have that discipline to replenish your policy the same way you would if you were going to borrow it from somewhere else. So
Okay.
that's by treating it with respect that way.
Sorry,
Okay.
let me jump in here real quickly too. Curtis, did you have something you wanted to say? Sorry.
No. I'm just listening.
Okay, so move your cursor, Christy. You're just away from that. So look, she's come up with 48, 483.58. That's what the payment is. Okay, now if you have a HELOC, you guys may be throwing extra money to the HELOC. I would suggest you do the same thing. Forget about the interest rate. That's $483. Why don't you just round that up to 500? If you round it up to 500 that you're paying, guess what happens? You pay it off quicker. But when you pay it off quicker, what you're doing is putting it back into your policy as almost as if it never left there. Okay, so you can pay it, and Nelson would say, be an honest banker. And what he means by that, if you're willing to pay somebody, I mean, let's go back to you, Curtis. If you've got money on a credit card and you're paying 28% for, you're giving that 28% is going to people who don't even like you. And they don't even know who you are, and they hope you won't pay it off quickly because they want the interest. That's why
Right.
they're charging you that 28%. So Nelson would say, if you're willing to give 28% or $500 a month to some organization that doesn't even like you and you're used to doing that, why would you not just put that back into your account? And what that does, quite frankly, is forget about the interest rate. What it does is replenish the money in your policy so you can use it again. That's really what's happening. Everybody focuses on interest.
Now I just switched this up a little bit because that before I was showing like the loan side. Now I'm going to show like, what if this was your policy? What if your credit line or your availability in your policy is 30,000, and then now you take a $20,000 loan from your policy and you've got this $30,000 credit line, right? Now,
Right.
as you're paying back this 500, so you've got this balance that you owe against it, right? And you've got this 20,000. At the end of the year, what's your balance on it? 14,938. So your credit line availability is the difference between this and this in that first year. Now with your policy, if you're adding to it constantly, let's say you're adding $10,000 a year to it and you're doing that every year for 15 years. So when you add, actually, I guess, really I should be adding this credit line to it. Sorry, that's not the right way to do that. But your credit line, if this is increasing every year by 10,000 and this is now at 40,000, and by the way, every year it gets better. Oh shoot. Anyway, you guys know where I'm trying to go with this. But your credit line is increasing because you're constantly adding to it. So if you've got a credit line now of 40,000 and yet the balance that you have on that loan is 9,600, your credit line is improving because you're adding capital to that account, that policy, but then you're also having the loan that you're paying down at the same time. So the difference between the balance on the loan and the credit line that you have, or the cash value that you have available, is what you still have available for whatever that next opportunity is that comes up. Do you guys get that? Does that
Yes.
help to kind of see it illustrated that way? So that's
Yes.
really what you're doing. Now, to your point, Curtis, if you have this where you're paying it at 600, then this availability, this balance goes down faster. Oh. So the faster that you pay it down, the more that this balance is reducing. And then it also is improving your credit line here because you're kind of refilling and putting it back. So you have two things happening at the same time with the policy. You have the growth, and then you have your availability and access that you have to use, which is why we say that your policy, you think of it as a life insurance line of credit, because the cash value that you have there is your availability. So the faster you pay back that loan against the policy, the faster you're improving that availability to use for the next thing that comes up.
Gotcha.
Part of the challenge here is Christy says the policy is growing, but you're also paying down a debt, but the policy is growing. I mean, think about this you guys hear me say this a lot. Think like a banker. When you owe a banker $30,000, you look at it as a debt. He looks at it as an asset. Now, by the way, think about this. Let's automatically move you guys all to 65 or 70 or whenever you're going to retire. Okay. How much money do you want to have owed to you when you are 70 years old? All you can get. Having money owed you is not a bad thing. It's a good thing. What do you think a bond is? A bond is as an IOU that you hold that IOU, and the bond, whoever issued the bond, is owing you that money. That's how a banker looks at debt. And that's a tricky thing for us to do, because you need to see it as a banker, as a borrower, and as a lender. And I use this analogy all the time. If I say to you, I'm going to the bank, I'm going to take a loan, who's talking, the lender or the borrower? I'm going to the bank to take a loan. Who's talking? Is that the lender or the borrower? I'm going to the bank to take a loan.
Borrower.
That's the
Borrower.
borrower.
Yeah.
Now, if I go to the bank and I'm going to make a loan, who's talking, the borrower or the lender?
The
The
lender.
lender.
No, I'm going to the bank to make a loan.
The banker.
That's the lender.
That's what they said.
I'm sorry. Okay. Now
I
I'm
was like,
going to the
wait,
bank
where are
to
you
make
going
a
with this?
loan.
Because that was the right answer, I thought. I'm wrong
This is
too.
hard. It's hard to bounce this around, but it's the same transaction, but the banker sees it one way, the borrower sees it another. And here's the tricky part,
The
guys.
liability to one and an asset to the other.
Yeah, you get to be both. Are you the borrower or the lender? Yes. And you're double-minded. The scriptures warn about being double-minded, but here you have to be double-minded. You have to see the same process from
I
both
like that.
sides of the table. That's why
Neither
many
a
times,
borrower nor a lender be, so be the banker.
yes, exactly right.
Be the banker first. Be the
And
banker
by the
first.
way, since we're getting religion into this, go to the New Testament, go to Matthew 25 and reread the parable of the talents
Oh, yeah.
from the perspective of a lender.
Mm-hmm.
Or, I mean, you'll see it differently.
Yep.
You'll see it completely. Now that you've been through this, you'll see that Matthew 25, you're going to see that differently than you've seen it before.
Now, hang on. I want to also jump in here for a quick second. That doesn't mean let's go out and just become a lender and do like consumer expenses and just give you a license to spend. Okay. Consumer debt is consumer debt. But if you have a loan, like let's say you wanted to start a business and you went to the SBA and you got a loan for that business that you're trying to purchase, is that loan helping you to acquire an asset? Yes. Okay. And so because of that, that type of loan is different. That's allowing you to, that's actually an asset that you're accumulating because of that loan that you just got. Understand that there's a very big difference. So a lot of the times people will say, okay, well, I want to hurry up and pay off my house. And it's like you're getting a tax benefit by having that mortgage interest write-off. You realize that you're giving that away faster. Now, there is some delta in between there as far as what you're giving up in an interest rate, in paying in an interest rate, and then what you're actually getting in tax bill by offsetting that by changing to a standard deduction. So I understand that there's a delta, there's a difference in between those two. But you want to be careful that when we're talking about paying off debt, you want to refinance consumer debt that is not benefiting you at all, first and foremost. That's going to be your first priority to do. So you look at auto loans, you look at credit cards, you look at expenditures. Those are things that make sense for you to not be paying out to somebody else ever. Now, at the same time, can you use your policy to finance things and lend to your business? Absolutely. And then you're able to double dip. But if you have all of those things collectively, you're going to start with the things that are not benefiting you at all financially or tax-wise before you're even going to focus on those others. So hopefully that makes sense. I want to touch on this because one of the questions and things that we wanted to go through is people will say, okay, well, if I'm going to use my policy, what other things can I use it for? Okay. Now there's different things. There's risk accounts that you can do, which is these that are listed here. And so these are some things that you can do. So you can use your policy for anything that you want to use it for. So we think the smartest and best way to use it is for things that you're already doing. So debts that you already have, refinance that and have it be interest that you can save and giving yourself a better rate of return on that because of the interest that you're saving, which we just talked about. Now, after you do those kinds of things and you do that for a while, then you're looking at it and going, okay, well, what if I wanted to do real estate? What if I wanted to do precious metals and mutual funds? Okay, so these are some different things here. So you want to,
Christy, you're not sharing your screen, just so you know.
I am. Are you guys not seeing it?
I'm not seeing it.
Only the
Yes,
drop-down menu.
Oh, okay. Yeah, that's all that's on there. So yeah, I'll share again. Sorry. So this right here is like talking about different account types. So you want to look at it from like a benefit and risk standpoint. Okay. So if you take one of these, it's going to tell you, okay, if I've got ETFs, all right, I've got a competitive return, I've got high contributions, I've got liquidity and use. So you look at all these different benefits and things that you can have with that particular asset class. Okay. Investment in real estate. So in an ideal world, when you're looking for something that's ideal, you're saying, okay, I want it to have as many of these things as possible. Okay, so you want to be able to know what that trade-off is. And so with the mutual fund, for example, your trade-off is that you're saying, okay, I have the potential for competitive returns, high contributions, liquidity and use and control. Okay, I don't have tax-deferred growth. I don't have tax-free distribution. So these are the things that you don't have associated with that. And so you want to just be able to understand the difference in there. People ask about precious metals a lot, same kind of thing. It's like, okay, you've got some of these things that you have as benefits, variable annuities. Okay, in an ideal world, you want to have as many of those benefits as you can possibly get. So let's do safe accounts. Okay, so those were risk accounts. These are some of the safe accounts. Now, cash is one of them. All right, cash, in my opinion, is losing interest because it's not even keeping up with inflation if you have it just sitting in your mattress. But these are some of the benefits to cash. Okay, then you've got CDs. Okay, you can do bank CDs, which is another place to be able to put it. So these are kind of like in that more safe bucket. So this gives you some different things on what you can look at benefits here. You've got fixed annuities. So you can put into a fixed annuity that's deferred, that you're basically saying, hey, I want to get a fixed interest rate, so I'm nervous about the market. Maybe we want to do some of this. Now, most people have a balance of some risk and some kind of more steady or more conservative. Okay, so everyone's mix is a little bit different depending on their age, their preference. Okay, you've got money market. You've got savings accounts, which again, a savings account, I would say high yield savings account, hopefully, because a regular savings account, you might be making 0.2%. And again, you're kind of losing money to inflation. Okay. There are no other things that give you all of the benefits that a cash value life insurance policy gives you. Because can you put it into a policy and then still do all of the other things that you want to out of this being your base camp? Absolutely. The only thing that it's not giving us is a deductible contribution. Because it's taxed the same as like a Roth would be, where we're basically saying, hey, we've already been taxed on that money. Now we're going to put it in and never have it be taxed again. Okay, so you want to be able to understand what the trade-offs are. And so if you're looking for something stable and something fixed to be able to do with your money, then that's where you're looking at these types of things. And so when you look at these as the options, then it helps you to be able to evaluate it. Now, another thing that people ask a lot is, okay, should I use my policy to invest in like a business or in real estate? Okay, I'm going to tell you guys a simple rule of thumb that is helpful, that's helped us, that we pass this on all the time. You guys have heard us talk about this. Those of you who have worked with us for more than 1 or 2 sessions, you've probably already heard us say this multiple times. But if you look at what you're purchasing, you want to look at what your cash on cash return is, right? Everything that you're doing with your money, you're saying, okay, I'm putting this much in, and then what am I getting in exchange? Now, in an ideal world, you want it to have as many of these types of benefits. If you're doing a property or you're doing a business, you want this same kind of thing, as many of those benefits as you can have to be able to minimize your risk. Because think like a banker for a second. Do banks take risk?
Ooh.
As little as possible, right? So
Right.
if you go to the bank and you say, hey, guess what? I have this great idea for this business and I want you guys to invest with me. Will they invest with you? Not a chance. Okay. What will they do?
They'll put they'll put it against your house. They'll let you
Give you a
leverage.
loan.
Okay. They'll give you a loan, right? Okay. Is that different than an investment? Absolutely, right? So them giving you a loan, now that loan, is it just a personal loan or is it collateralized?
It's collateralized.
They're going to collateralize it up the wazoo. As much as they can collateralize it, they're going to.
They'll
Okay.
put a
Because
second on your home.
they want to limit their risk. And so if it's a business, then they're going to like leverage it against the business. If it's against your house, they're going to leverage it against the house, meaning they're going to put a lien against the business, a lien against the house, even a lien against an auto loan, right? So everybody wants their ability to limit their risk. So understand that the banks make a killing. And the more we can think like a banker, the more profitable that we can become. So instead of trying to do all these high risk investments, whether it's market accounts or whatever, like I'm not against market accounts. I'm saying you need to hedge some of that to be able to say, okay, don't put all of your eggs in that market basket where all of that is at risk. My dad said a long time ago, he said, if you can't afford to lose it, you can't afford to invest it. Okay. Another rule of thumb is to say whatever your net worth is, don't risk more than 10% at any given time. Now, if that 10% that you use, so if you've got 500,000 in net worth right now and you use 50,000 and you put it into an investment and that investment pays off big for you, guess what? You increased your net worth and now you can do the same thing again. Now let's say that turned into 60,000. Now you can use that money and you can now do the same thing, but use the bank's money, not your own money. And so leverage your risk and have it be at a reduced amount. The rest of it, just know that the policies themselves will grow fantastically well and give you opportunities to refinance your auto loans and all of those things that you naturally need. So leave the availability there for those kinds of things and don't use it for risk kinds of things. Because if you use your policy for a risk opportunity and that doesn't pay out, then you just dug yourself a further hole and you just drained your asset ability to use for the next thing. So these are some things that you want to keep in mind. Now, one thing with the business and with real estate, okay, 1% rule. So if you've got a business or a property that's worth, let's say it's $1 million, 1% rule says that you want the gross amount, gross revenue on that, gross revenue or gross rents to be 1% per month, okay? On $1 million property, that would be $10,000 per month. Times that by 12, that's $120,000 for the year, okay? Now, you want to have your net amount that you're actually receiving be 20% of that. So using that same rule of thumb, if it was $10,000 per month, then you want to have $2,000 per month be your net after all of costs and everything else are taken into consideration, okay? Whether it's business or real estate or an investment or whatever, you want to be able to have at least a 20% profit. If you don't have that, don't do that deal and then wait for the next one. Because when you have access to capital, which is what you're doing when you're accumulating these policies, these opportunities will come. And if you just used it for a high risk something and you didn't get it paid back, and then something else that comes along is like an amazing slam dunk deal that's low risk, you're going to wish that you had left it in the policy and been patient to wait for that opportunity to come around instead of jumping at every single little thing that comes up that tells you that they're going to give you a 20% rate of return. Okay, so just be careful with how you're using your money and kind of use that 10% of your net worth rule as a benchmark, trying to limit how much you're willing to risk, and then also being able to say, if I can't afford to lose it, then maybe I shouldn't be investing it. Okay. Have you guys heard
Question on
about
what?
bigger pockets?
Yeah, go ahead.
I was just saying
Just-
that there's something that just came out. One of the main guys at Bigger Pockets is now like having a lawsuit and massive legal downfall because he's had all these investors that he hasn't been able to pay back. I think it's like a $15 million amount, and people are saying, hey, I trusted him because he was this big guru at Bigger Pockets, and so I invested my money with him, and now these investors are not getting paid out. So you guys, the markets are getting dangerous right now, and so please just make sure that you're careful. If you're investing in anything, you're taking that risk and that gamble. And I'm not saying not to take it. I'm saying just understand what you're getting yourself into and be careful that you're not going into things and giving that person too much of your access to your capital. If you can't afford to lose it, don't invest it. Because these people that said, hey, I thought it was going to be a guarantee, this guy knows what he's doing, and now they aren't getting their money back. And so no matter how good a deal looks, it's only as good as the markets and everything else. And that's what the Bigger Pockets guy is saying, is he's like, hey, it's not my fault. The lenders did this and the taxes did this and the economy did this. And so there's not, I mean, no matter how much a skilled person is, you can't do anything about the economy and the taxes. Those are deal killers. And so it's not his fault, but the investors can't blame him either. You need to understand that the risk that you're taking on is that you know that those things can happen. So don't be willing to risk it if you can't afford to lose it.
So another way of looking at this is shop at home first. In other words, there's plenty of opportunities in your own family. Nelson used to say that you should be taking, I mean, that before you ever lend outside to anybody, you should, he says that should take about 20 years. You've got 20 years of lending to your family that you could do. And part of what that is killing the snakes and dragons, if you will. And what that means is money that's going to somebody else. Now, Jerry asked a great question. We sort of answered it, but I want to come back and talk about it. So if you're borrowing money from the insurance company at 4.3, and let's forget about the interest rate. Let's assume that in order to pay that back over, let's pick a time frame, 5 years, you'd have to pay, $200 a month. I don't care what the interest rate is, $200 a month. Well, what if you pay back $300 a month? You got an extra $100. Where's that going? It's going to pay down the principal. Remember, it's a line of credit. It's a life insurance line of credit. How does that work? If you're only expected to pay back $200 a month and you pay back $300, what it does, I mean, yes, you can figure out what that rate of return is, but that's not the issue. I mean, Nelson used to talk about everybody focuses on the interest rate. They don't focus on the volume. And he used the example of giving yourself a shot, or every Monday morning I give myself a shot, and the stuff that I put in there, it takes forever to pull it into the syringe. It takes a long time to get there, but it's not the interest rate, how fast I'm giving me the shot. It's how much stuff I'm putting in because I do it in my leg, how much venom, or how much medicine, if you will, or how many dollars are going back into your account. That's what you should be focusing on. It's not the interest rate, it's the volume. And that tricked me up for a while because I couldn't figure out what is he talking about volume? He's talking about cash flow. In simple English, he's talking about cash flow. Cash flow is what it's all about, not the interest rate. It's the flow of the cash. So anyway, so if you have extra that's going back, it goes back into your policy. It goes back faster. Okay, and if you get to the point where you can you're financing, if you're financing enough, you're going to be able to make your premium payments from just using your financing. That's a whole nother discussion, and we don't have time for that now. So if you guys will take a minute and update this this poll that we just put up. I didn't see very many comments this time. Maybe I'm not seeing them right. Christy, are you seeing some?
We didn't have as many
Jim, I
comments.
couldn't get my survey to go past number 3, so I just submitted it. It wouldn't scroll for me.
You had chat disabled this time, just so you know.
Yes.
Oh,
Yep.
weird. Okay.
No wonder you didn't want to say anything.
Sorry, you guys. All right. Well, we've got, or at least I can stay on for a few more minutes if anybody else has any other questions. But otherwise, we appreciate you guys being here. Hopefully, this was helpful. But I think the moral of the story on a lot of this is being able to understand that the value of the policies themselves, whether you're doing anything with that money or not, having that availability for you to have in case things come up or when things come up is valuable already and going to give you a high rate of return because of the interest that you're able to save by being able to finance it through your policy and have it still continue compounding. So hopefully that gives you a little bit of a break to not feel like that you have to try to chase these high rates of return when getting more efficient with your money actually gives you a higher rate of return. If you find opportunities and you can do that, then great, do both. So, but don't feel like that you have to take risks to get ahead because you really don't. So, but we appreciate you guys being here. The poll is helpful. We may be switching up our summer schedule, so we'll keep you posted. Watch your email. But thanks for being here, you guys, and have a great weekend. Unless anybody has any quick questions too.